Hello, I'm Yutaka Watanabe, a tax accountant. Welcome to the channel. Tax Accountant Nabe solves your money problems. Today, I'd like to talk about what to look at in revenue items in small-scale M&A. When people decided to acquire a company, many tend to look only at the top line of the profit and loss statement, the sales revenue, and think those are pretty good numbers, but that alone is nowhere near enough. To identify a truly valuable acquisition target, you cannot simply accept a list of numbers at face value. You need to uncover the true quality hidden behind those figures and become, in a sense, a financial detective. People often say numbers never lie, but the way numbers are presented can easily create a misleading impression. Whether you can see through that illusion often determines success or failure in M&A. Today, I'll thoroughly explain exactly how to do that. Now, let's dive deeper. The first question we should ask ourselves when investigating beneath the surface is, will this revenue really continue into the future? In small-scale M&A deals, it is crucial to investigate what is actually hidden behind the attractive numbers in the profit and loss statement. Even figures that look excellent at first glance may disappear surprisingly quickly tomorrow. That is why the first step in our investigation is the dissection of revenue figures. You should never simply accept total revenue as one large lump sum. Instead, you need to analyze the numbers using two scales, composition and continuity. Understanding exactly what elements make up the revenue is literally the key that determines the success or failure of an acquisition. Why is examining revenue composition so important? Because it clarifies the difference between dangerous dependence on specific clients and well-diversified customer base. Without understanding the contents of the revenue, you cannot properly negotiate price, manage risk, or build future business plans. Imagine this for a moment. Suppose a web production company depends on the major client for 80% of its sales. The moment that client says, "We are terminating the contract next month," the business collapses instantly. This is not an exaggeration. It is actually a common tragedy in the world of M&A. That is why it is essential to determine whether the company is dangerously dependent on a specific customer and whether the customer base is properly diversified. Ideally, the top 10 clients should account for no more than around 60% of total sales. Consider that one useful benchmark. Another extremely important point is to strictly separate temporary spot sales from recurring revenue that can be relied upon in the future. Only after removing one-time revenue that happened to appear this fiscal year can you truly understand the real health of the business revenue structure. always confirm how much stock type recurring revenue exists, such as monthly subscription services and annual contracts. What we really need to know is whether stable, continuing revenue can reliably support the business going forward. Now, let's raise the alert level a bit. When evaluating small-scale M&A targets, there is one particularly dangerous and easily overlooked hidden trap: founder dependency risk. The smaller the organization, the more likely it is that the business depends heavily on the owner's personal relationships and individual skills. Revenue built solely on the current owner's charisma or unique network carries a serious risk of disappearing completely the moment the owner leaves the company. Imagine taking over the business and seeing sales evaporate from the very next month. That is a frightening scenario. To avoid hearing sales were steady every month until the handover, but dropped sharply immediately afterward. You must thoroughly verify this point in advance. So, what can we do? This is where we need to completely change our perspective when evaluating our business. Instead of relying on one superstar individual, we should determine whether the organization or business system itself can continuously generate revenue as a team. This shift in mindset is an absurd requirement for ensuring a bright future for the business. That is what it truly means to evaluate organization strengths. In practice, achieving a sale and successful M&A transaction can be summarized in two key steps. Step 1 is to evaluate the organization's true earning power after completely removing founder-dependent elements. Step 2 is to evaluate the overall growth potential of the market in which the business operates. Only when both of these conditions are met can the acquisition truly be considered valuable. Carefully evaluating both the organization's earning power and its future potential as a balanced set of two will driving the business forward becomes the sure roadmap to success. Finally, I would like to leave you with one important question to think deeply about. Are you trying to buy an organization, or are you simply trying to replace an excellent salesperson? I hope this gives you an opportunity to reconsider what you are truly trying to acquire in your next deal. Do not be deceived by the magic of surface level numbers. Develop the eyes of a financial detective who can uncover true value and confidently approach your next acquisition opportunity. Today, I spoke about what to look at revenue items in small-scale M&A. For more information about small-scale M&A, please visit the website Yutaka Watanabe Tax Accountant Office. I will continue sharing content related to money and finance, so please subscribe to the channel. Tax Accountant Nabe solves your money problems.